If a beneficiary has the right to receive all of the income of a trust, and they give up that right, that is treated as a gift of an income interest for gift tax purposes. However, it's not a gift of the underlying principle of the trust that generates that income. But there's an exception to that general rule, and that applies in the case of a QTIP trust, which is a trust created for a spouse that elects to have the marital deduction applied for gift or estate tax purposes. QTIP trusts give a mandatory income right to a spouse, but there's a code section, 2519, which says that a relinquishment of a spouse's mandatory income right in a QTIP trust is also treated as a gift of the underlying principle. This was illustrated in a recent private letter ruling. This makes sense because, ultimately, at the spouse's death, the balance of the QTIP trust assets will be included in the spouse's gross estate under Code Section 2044. But this gifting principle could create a great gifting opportunity right now for spousal beneficiaries of an existing QTIP trust, which might allow them to easily use their high exclusion amount before it's reduced. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. For today's episode, episode 191, we're going to look at an illustration of gifts of interest in a QTIP trust under Private Letter Ruling 2021-16001. As always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. And if you would like a copy of these slides, you can email me at griffin.bridgers@gmail.com. Now on to the presentation. So, with Q trusts, if you have a life estate equivalent type of trust for the sole benefit of a spouse, which we won't get into here, we'll talk about the technical qualifications another time, but you can make an election possibly as to whether or not to apply the marital deduction to that trust. Now, if the trust is funded during life, then there could be a gift tax marital deduction as long as this at the time. Now, if it's a transfer at death, it could also qualify for the estate tax marital deduction as long as the spouse is also a U.S. citizen then, or as long as the transfer is to a QDOT trust, a qualified domestic trust. Now, all that being said, the cost to getting the marital deduction is the QTIP election, and that simply defers if the spousal beneficiary either makes a gift or dies, at which point the spouse's applicable credit is applied. So what's happening here is we're simply deferring estate or gift tax, and we're ensuring that the property in the QTIP trust won't use the exclusion of the donor or grantor, but instead will use the exclusion amount of the spousal beneficiary. And that's illustrated in Code Section 2044, which says when the spouse dies, the balance of the QTIP property will be included in the spouse's 2044 at its date of death fair market value on the alternate valuation date. Now, that aside, why this is important is if you run into a situation where maybe a spouse is deemed to make a gift of an interest in a QTIP trust. And that's exactly what the case was in Private Letter Ruling 2021-16001. And in this case, there wasn't necessarily an intent to make a gift, but what happened is that there was a QTIP trust that was divided into a new share and a continuing share. For the continuing share, there was really no change to the trust terms. However, for the new share, the spouse gave up their income and principal interest in that continuing share. Now, any time you give up an income interest, regardless of whether it's a QTIP trust and regardless of whether it's a spouse, the beneficiary who gives up that income interest is treated as making a gift of that income interest that they would have received over the rest of their life or over the remaining term of the trust. But there is no gift of the underlying principle that generates that income. However, in the case of a QTIP trust, Code Section 2519 treats a spouse as the tax owner of the underlying principle of that trust, because down the road, as we recall, Code Section 2044 is going to include that principle in the gross estate at its date of death fair market value. So if you're giving up your income interest, it stands to reason that 2044 could be circumvented without some sort of corrective code provision. And that's exactly what we find in Code Section 2519. And that's what was ruled here, is that this was a two-part gift by the spouse. The income right, which would usually be taxed under 2511, and the principal right, which is taxed under 2519 because of the QTIP election. And that would be the case even if the spouse had no right to receive that principal, which they don't have to have that right for there to be a valid QTIP election. All they have to do is be able to receive all the income of the trust. Now, that being said, from a valuation perspective, I've talked about in prior episodes the valuation of a life estate. You can use IRS Table S for a single life estate, determine the age of the life estate holder at their nearest birthday, and the 75/20 rate for the month of transfer, and that gives us a present interest factor, which tells us how much the present value of the right to receive income for the rest of that person's life might be. And that amount could be quite low, depending on the higher the age of the life estate holder and the lower the 75/20 rate. Now, obviously, the income beneficiary's release of that life estate generates a taxable gift of the income interest, and there's no gift of the underlying principal. So, key takeaway here is that for a spouse, we have to add principal to the gift amount, because otherwise we would circumvent the inclusion of that QTIP property in the gross estate ultimately. Now, this could be a huge gift opportunity, and we'll talk about that in a second. But one more time, I just want to remind you of the key takeaway from this private letter ruling, being that there is a two-part gift here. Part of the gift is a gift of the present value of the income interest, and the remaining value of the gift is a gift of the underlying principal of the QTIP trust. Now, if you're truly intuitive, you might recognize that both of those just simply add up to equal whatever the fair market value of the trust might be at the time of the release of the income interest. And you're right, but since two different code sections govern this, it's two different calculations that really go into that release. And if this had not been QTIP property, in other words, if there had just been a marital trust with no QTIP election, then the spouse's relinquishment of the income interest would have been the only gift here. We would have just had a gift under Code Section 2511 equal to the present value of the income interest. Now, if you have an income right that's not mandatory, but is instead discretionary, and maybe an underlying discretionary principal distribution right, that amount may be not, there may be still a gift, but it may be nominal. And there is no valuation guidance in that sort of circumstance. What we have here for valuation only applies to a mandatory lifetime income interest or an income interest for a term of years. There's nothing out there really governing how you value a discretionary income and or principal interest. What the IRS found in Private Letter Ruling 2011-22007, which is almost 10 years ago, was that there is indeed a gift when you release a discretionary trust interest, but the amount is nominal, and the IRS refused to rule on that valuation principle at the time. And in 10 years since, we've gotten very little, if any, guidance. No. So, if we are looking at this holistically, we might recognize that this is a great planning opportunity as a gifting strategy. Because if you have a spouse who has an interest in a QTIP trust and doesn't need that interest anymore, they don't need the income from that trust based on their own assets, then this could be an easy way to make a gift. The spouse could simply relinquish or give up their interest in that QTIP trust, which would be treated as a gift of whatever the fair market value of that trust is at the time of relinquishment. So it doesn't matter what the 75/20 rate is or what the spouse's age is, that's going to create a gift of whatever the value of the trust might be. And the reason this is a great strategy is because ultimately that property is going to be included in the surviving spouse's gross estate anyway under Code Section 2044. And if it's invested for income, then chances are the principal amount is going to stay consistent, maybe even grow a little before that time if the spouse is only taking income distributions anyway. So, since the spouse has a higher exclusion now, and it seems likely that it will go down possibly prior to the spouse's death, it may be better to use the higher exclusion now while the spouse has it to give up that interest in the QTIP trust. And that's a great way to avoid having to start fresh to draft a trust, make a transfer, and value that transfer for gift tax purposes. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.